All right. Today is Monday, the 20th of March. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's begin with this. You know, last week, the CEO of Credit Suisse kept saying that our financials are very healthy. Once they say very, understand that things are about to blow up. And of course, over the weekend, we got a lot of scary news. We found out that Credit Suisse is kaput, gone. And now, of course, the staff is angry, the investors are pissed off, the bondholders are dead. And over the weekend, of course, things were looking as, this is the end of the world now. And you know, when the government starts to call Sugar Daddy Buffett for a bailout because the government is running out of cash now, things are really bad. I mean, think about this. When the government starts calling Buffett and says, Mr. Buffett, we're running out of cash, we're in trouble again. Please help us out. You think this marks the beginning of the bull market, you fool? Or is this the beginning of the crash and the beginning of holy shit, we're going down? Not just in the stock market, but the economy too. And of course, every time the government calls Buffett and says, hey, can you bail us out, please? We'll give you a deal on these banks. Of course, Mr. Buffett's going to grab these deals, just like he grabs a bag of McDonald's McMuffins. And things, of course, were terrifying in the morning. European stocks were down. UBS was down by over 8%. The Dow Industrial Average was down by almost 400 points in the pre-market session. And then, by the end of the day, the stock market managed to close. Yep, you guessed it, in the green. How did that happen? Well, maybe what the Maverick of Wall Street already explained to you in the morning, in my morning brief in Discord. I told you guys right away we're going to have a de-risking session in which the winners from last week will be soft today and the losers will catch a bid. So you got profit taking from the winners from last week and you got short covering from the losers of last week ahead of the FOMC. And I gave you a few names such as the winners, NEM, Newmont Gold, the Qs, the Nasdaq, Microsoft, Coinbase. When we look at these, Newmont Gold was down about 0.75%, and then you got the Nasdaq was up slightly, be it flattish, although underperforming the SPY. We talked about this also last week, that we're going to see the SPY outperforming the Qs all the way to the FOMC. And of course, we look at Microsoft down a little over 2.5%, Coinbase flattish. It's going to take a little while before it goes down, but that depends on how Bitcoin is going to react in the aftermath of the FOMC. What's going to happen to the dollar? What's going to happen to yields? That's of course anybody's guess, and Bitcoin will react accordingly based on the dollar and yields. We talk about losers. We talked about IWM. We talked about Nucor, we talked about Halliburton, we talked about MetLife. And the Russell 2000, the IWM, managed to outperform today, closing positive by about 1.3%. We look at Nucor, also outperforming gold, so we see steel outperforming gold, at least today. It was the opposite picture last week. Nucor up a little over 2.5%. And then we see Halliburton, oil, also rebounding, closing positive by almost 2.5%. And then we got MetLife also bouncing higher, closing positive by almost 4% for the day. Now, a lot of banks also bounced, but then they moved down by the end of the session. And therefore, I'd rather buy the dip in life insurance because it went down in empathy with all of them, but these companies don't have the same problems. So all in all, the session today was easy peasy lemon squeezy. It's about to get really hard as we get closer to the FOMC. So I keep telling you folks, always be closing in these kind of days. Always be closing. But unfortunately, a lot of you want to stretch these trades all the way till death. And then you come to me crying, hey Maverick, the trade was a losing trade. We lost money. What happened? What happened is you gambled, sweetie. That's what happened. And of course, when we talk about Credit Suisse, that's the herpes of banks. You gotta stay away from it. Don't even touch it. It's toxic. Any company, any bank that touches Credit Suisse will get sick. So now we have $17 billion of debt becoming worthless. Gone. All of the bondholders of Credit Suisse, they're dead now. And among them, of course, this is the contagion impact. We now find out who the cockroaches who've been hiding under the rock. And we now know that PIMCO and Invesco are among the largest holders of Credit Suisse additional Tier 1 bonds that have been wiped out. Goodbye. And of course, the Saudi National Bank, the SNB, which initially kind of bailed out Credit Suisse. And in this program, we predicted that Credit Suisse will go bust and it will be a Lehman moment. But of course, the Saudi National Bank came to the rescue, and all what they did is just delay the inevitable. And back then we said it's a dumb deal. Why would they gamble with the money on a zombie? And now we know that the Saudi National Bank lost $1 billion in their bet on Credit Suisse. So now you see the contagion. PIMCO is getting hit, the Saudi National Bank is getting hit, and many more. And of course, they say now with the Swiss government bailing out UBS after the takeover of Credit Suisse, UBS is now the world's safest bank. Wait till UBS blows up. because now UPS got herpes. And then, of course, they say that Credit Suisse received a clean bill of health by regulators, and it took less than a week to completely collapse. And I say these are the same regulators who, oh, wait a minute, I don't need the joke for this one. I think the jokes are writing themselves right now. We should just add a laugh soundtrack at the end of this headline. Credit Suisse received a clean bill of health from regulators, and it took less than a week to completely collapse. And maybe the regulators should have listened to the kiss of death by Jim Cramer, who came out last year and said that Credit Suisse is a great franchise. Jim Cramer and other Wall Street experts say the panic over Credit Suisse, is highly overblown. Why now might be an opportune time to jump in, if you want to go bankrupt, of course. What's up with these aging banks blowing up all of a sudden? We got Lehman Brothers, that's a 100 years old plus bank that blew up back in the great financial crisis. Now we have Credit Suisse, which is 160 years old plus, blowing up. What's going on here? Meanwhile, look at Rupert Murdoch. That's an aging bank who's getting blown, not blowing up. And they say, oh my God, but the Federal Reserve and the regulators had all of these stress tests over the banks. How did they miss out on Silicon Valley Bank? I say maybe the Fed needs to update their stress test to match the kind of stress test that Rupert Murdoch arteries go through after popping a dozen Viagra. I mean, with all of these aging banks blowing up, how come we never hear this kind of headline? Australian business titan Rupert Murdoch dies at the age of 92 after overdosing on a hat full of Viagra. And of course, everybody's now watching the Fed. What is the Fed going to do? What is the Fed not going to do? Because here's what's going on right now. Even after the drop in the 2-year yield and the 10-year and all of that, the risk premium for equities remain way too low. In other words, even with the drop in bond yields right now, it's not worth it to buy stocks. So the only outcome that the stock market should be hoping for is for the Fed to announce cutting rates right now. Because even if the Fed announces a dovish hike, as they say, these morons, meaning 25 basis points and then pause, that's not going to make the risk premium for equities worth it. And the danger, of course, becomes, are we about to abandon the fight against inflation and pause interest rate hikes because of this bank, Credit Suisse, that got caught money laundering and dealing cocaine? And we wonder why the bank went bust? We're going to stop the fight against inflation because of this? Give me a break. This was inevitable. We should be celebrating that trash companies like Silicon Valley Bank and Credit Suisse are finally going bust. It was just a matter of time. All what the Fed has done is just press the button of the inevitable. Trash will always be trash. And speaking of trash, we got a good one for you here tonight, because we're not going to crash until one stock start to give up. And this stock is NVIDIA. So let's talk about it. And here it is. In focus tonight. Overhyped trash. That's what NVIDIA is, aka the Balenciaga of stocks. What am I talking about? You might have heard the talking heads on TV throughout the last 2 weeks saying, oh, the outperformance by big cap technology stocks, also known as the FANG stocks, Facebook, Alphabet, Amazon, Apple, NVIDIA, Netflix, Google, whatever you want to name over there. The reason why we're seeing the outperformance of these stocks is the rush to safety. When investors hear about all these banks blowing up, they want to rush to the safety of these big caps because they're so good, are they? When we look at the revenue growth for these companies, the lowest reading ever. That's safety. And when it comes to NVIDIA, I say, look, it has a complicated relationship with Jim Cramer that is getting a little creepy now. The guy says he's not ready to take profits from NVIDIA and sees the stock at $10 trillion one day. Then the stock goes down. That was the top right there and then. And Jim Cramer says, buy the dip and stay long NVIDIA. Then the stock keeps going down. Jim Cramer says investors should not write off NVIDIA. And then the stock keeps going down. And Cramer comes out and finally capitulates and says he is concerned about NVIDIA. As a matter of fact, he is short NVIDIA because it is a loser. And right there and then, that was the bottom of NVIDIA. And the stock shot up higher by over 100% since then. And then, of course, Jim Cramer comes out and says, oh, I stuck with NVIDIA throughout the stock downturn. Okay, maybe it's time for NVIDIA to file a restraining order. But here's the latest call by Jim Cramer regarding NVIDIA. People need to realize that NVIDIA is sitting on a gold mine. And I say with the recession coming, I'd rather actually sit on an actual gold mine, because because gold prices are moving higher. But this trash is going down. When we look at the year-to-date performance of NVIDIA, it is the #1 stock in the entirety of the stock market right now, up about 77%. So you might look at this and say, hey, Maverick, but maybe NVIDIA is actual safety. Maybe the company's fundamentals are really good besides the AI. I say no. NVIDIA is the Balenciaga of stocks. You know, the company that sells you overpriced trash and the rich monkeys pay for it anyways because it has the Balenciaga label. The company scours its fashion from Skid Row in LA, paying homeless folks $1 a piece to take their clothes away, and then they sell them for rich folks for thousands and thousands of dollars. It's genius when you think about it. All what you need to do is just one sale. So the product costs you $1, but you sell it for $4,000. You only need one fool to buy the product. One product, and you're done. You already made your profit margin. When you look at this trash, you got destroyed hoodies for over $1,000, dirty jeans for over $2,000, hoodies with holes on them, that's over $1,000. If you want to wear your pants as a top, that'll cost you about $1,500. They actually sell trash bags, actual trash bags, for almost $2,000. And that's exactly what NVIDIA stock is. It's overpriced trash. The price to sales ratio is insane. The price to earnings ratio is insane. Even the price to earnings growth ratio is out of whack. And just like Balenciaga, the stock of NVIDIA is an illustration of the de-evolution of humanity. All what the company needs to dangle is a new banana called AI. AI, look at this. Look at this shiny object we call AI. And the monkeys will stampede to buy the stock because it is the future, bro. AI is going to take over. Okay. If I sell you my 96 junk Chrysler car for 50 grand, would you buy it? Of course not. But when it comes to Balenciaga, just like when it comes to NVIDIA stock, retail investors will pay for that. It doesn't matter what the company produces in earnings or revenues. It's all about what banana the company is dangling for the crowd. Of course, to trap them so the executives can sell and walk away rich. We look at the latest earnings report by NVIDIA. Year on year, the revenue is down by 21%. On the other hand, expenses are up by 27%. So you got the growth in revenues down big time, yet the growth of expenses rising higher. That's the future, isn't it? And therefore, the net income is down by 53% year on year. Oh no! And it gets even worse. When we look at the balance sheet for the company in the latest quarter, their current assets grew negatively by 20%. So they lost about 20% of their assets. When it comes to total assets, that's down by 6.8% year on year. And here's the catch. Assets should have been down by even a larger margin, but they only went higher because inventories were up year on year by 98%. Now that's bad. Why is it bad, Maverick? Because they're oversupplied. They have a lot of inventories that they cannot sell right now. On the other hand, when it comes to their liabilities, the current liabilities up by 51.4% year on year, and total liabilities up by 8.56% year on year. That's a great company, isn't it? Great buying opportunity. When it comes to the cash flow statement, net cash is down by 26% year on year. And remember all of these banks blowing up because they've been holding all of these assets till maturity, and they've been losing insane amounts on these assets because yields are going higher and the prices of these assets are going down. Well, guess what's going on with NVIDIA? The proceeds from maturities of marketable securities down by 64.5% year on year. NVIDIA is holding a massive bag here. All of the assets that they bought till maturity, they're now holding a massive bag on them. Yet the company, of course, using whatever cash they have left, you guessed it, to buy back stock, repurchasing their own stock. Why would they do that? They pump the stock higher, and then when they get caught, they fluffed up the stock too much, and now there's a massive divorce between the stock price and the fundamentals. The executives exit, they dump stock, they say goodbye, thank you so much to the mom and pops for chasing the AI banana, and now we'll leave all of you holding the bag. But lucky for you, it's going to be a Balenciaga trash bag. Come on, it's a good deal. Now, when it comes to the technicals of the company, last week I said this: NVIDIA is getting close to closing the gap at 259.20. A lot of call options holders and buyers, they've been targeting 260. That was the ultimate target from the get-go. Okay, once we get to 260, what happens next? If we don't have new buyers piling in the pyramid scheme and pumping NVIDIA stock higher, it's going to go down. And here's the chart that I shared with you back then, and the gap, as you can see, standing at 259.20. But the mechanical target was 260. Now here's the update, we got to 260, and now we lost 259.20, at least for now, and the stock is getting severely overbought. Just look at the weekly chart, and every time we saw such readings on the RSI, the stock went down big. In 2020, it went down by about 40%, and then again in 2020, in a similar reading, it went down by about 20%, and then in 21, when the RSI got to the same reading, it went down by about 15%, and again, the top in 21. Since then, after that reading, NVIDIA went down by about 68%. Now, we're at the same reading, and the question becomes, will NVIDIA go down to the next legitimate support at around 207.65, which also happens to coincide with a steep trend line? That would be a downside of about 20% or so from this point on. When we look at the hourly chart, it appears that we have a bear flag pattern at around 259.20, and that's the gap support / resistance. It did play out, but the dip buyers did show up today, although did not close above 259.20. So it appears, at least for now, that the chart is running out of steam. And of course, right now we have the AI event for NVIDIA going on. And if you do recall, the rally in Tesla was in anticipation of the great revelations of Grand Master Plan 3, which was a bust. It was just Elon Musk shooting the shit, cracking jokes, and talking about stuff that will never happen. And of course, that was the turning moment for Tesla. And since then, it went down big. Are we about to see the same thing in NVIDIA? Because the majority of this rally was in anticipation of this event. When you look at the stock market psychology chart, and then you look at the monthly chart for NVIDIA, you can't help but to wonder, isn't this the return to normal stage? I mean, look at it. This is the monthly chart of NVIDIA. We are amidst an insane rally since October of last year. Is this rally the back to normal stage? And if it is, then the chart is going to go down big. We're about to see the entry of the fear stage. Now we covered the fundamentals and the technicals. Let's go over the mechanics. We'll look at the options grid for this week, the calls, Monday, Tuesday, Wednesday. The volume is really important. What is the volume? The volume is what people are buying and closing within the same day. But that sends a feedback to the market maker. If folks are buying out of the money calls in large quantities, the market maker has to hedge by buying the underlying stock. And therefore, we see whatever stock it is, doesn't matter what the ticker is, we see the stock moving higher. Because folks are buying call options, that sends feedback to the market maker, who in turn, of course, hedges by buying the underlying shares, and we see the stock moving higher. But what if the momentum of buying slows down? We don't see such large volumes anymore, and the market maker has been buying the underlying shares for a long time. What if we see folks buying puts instead in large quantities? This marks the top and the reversal of whatever stock it is. When we look at NVIDIA, where is the highest volume for the day? These are the options with the expiration date of this Friday. We see 260 once again. It has the highest volume and it has the highest open interest. But now the stock is trading below 260. So by the end of the week, whoever is holding the 260 calls, if the stock indeed closes below 260, they end up losing all of their money. The contracts are going to expire worthless. And then you look below 260 for the open interest. Look at the 250, for example. It has about 7,000 contracts open right now. And we see that the majority of the high open interest for contracts that are now out of the money. So now the stock is trading out of the pressure zone when it comes to calls. Keep your eye on the 250. About 7,000 contracts open right now. As the stock starts to slide down closer to 250, what happens? When we look at puts this time around, we can see that the 252.5 contract has about 9,000 open contracts right now. Meaning, as we get closer to this contract, 252.5 and then 250, and even beyond that, we see more open interest for these puts. The market maker has to hedge the other way, and they do that by dumping the stocks that they own of NVIDIA. Furthermore, when we look at the monthly expirations for April, these are the calls, and when it comes to longer expirations, the open interest matters more than volume. The volume matters more in the short run. The open interest matters more in the long run, because these are the contracts open right now. We see the highest number at 250 for the calls. What if the stock keeps moving closer to 250, maybe below 250 as we get closer to the monthly expiration in April? These contracts will be out of the money. And below 250, there's not a lot of open interest here. So the market maker has to look for feedback from the other side, from the put side. When we do that, what do we have here? We can see that 250 also has a high number of open interest, but the number of open interest for calls in the 250 is higher. So the market maker would not mind if they see NVIDIA shares trading below 250, because that ensures that whoever is holding the 250 calls by the monthly expiration, they will get scared and close their contracts. But then that leaves the 250 contract for puts open, and that would be in the money. meaning that the market maker, by the expiration date, if NVIDIA closes below 250, is obligated to buy NVIDIA at 250, regardless of what the current price is. So they will try to keep shares of NVIDIA at around 250, maybe a little below, until further feedback. But what if we have more selling pressure? Because a lot of folks bought NVIDIA because of this AI event, and the AI event is a bust, for example. We see them selling NVIDIA shares all the way closer to 230. Now remember, we're looking at puts right now. Between 250 and 230, we don't see a giant number of open interest. But as we go below 230, the number of open interests start to increase dramatically. In other words, just in plain English, if selling pressure pushes NVIDIA below 250 and it starts to appear that the stock is about to break 230 as support, the market maker will scramble and start dumping shares of NVIDIA to hedge against all of these puts that are about to become in the money. And it becomes a self-fulfilling prophecy known as a reverse gamma squeeze or a short gamma, in which the selling pressure intensifies. Okay, Maverick, all of this is good talk, but I did not understand anything at all. Tell me, should I short NVIDIA right now or not, or should I go long? Here's what I'm going to tell you. If the stock does indeed close below 250, that would be shorting signal number one. But the ultimate confirmation would be losing 230 as support, because that is the line from which the market maker will start dumping shares of NVIDIA aggressively. So 230 will be the confirmation, aka the doubling down point. You put it all together. The fundamentals don't make sense at all. The valuation don't make sense at all. The technicals are way overstretched. And the stampede of buying call options is drying out. This makes NVIDIA at the current valuation right now, as it stands right now, an overpriced trash. Now, we're not saying the company is trash. Balenciaga is not trash. They make a lot of money. But the product, in this case the stock, is trash. It's not worth the price. That's what I'm telling you. Anyhow, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average closing positive by 382.60 points, or a gain of 1.20%. The Nasdaq also positive but lagging, up by 45.02 points, or a gain of 0.39%. The S&P also positive by 34.93 points, or a gain of 0.89%. We'll look at the sectors, all positive, but this time around led by materials, energy, and defensives, aka the laggards from last week. On the other hand, the winners from last week lagging today. We're talking about cyclicals, technology, and communication services. Moving on to the breadth, what do we see here? The NYSE 71% advancing versus 28% declining. The Nasdaq, on the other hand, 47% advancing versus 50% declining. We have the divergence. Last week, the Nasdaq outperformed the NYSE. Now we're seeing the opposite picture. This is just rebalancing ahead of the FOMC. Moving on to commodities, what do we see here? We have a modest rebound in crude oil, be it in the WTI or Brent, all closing with gains of about 1%. Of course, that comes on the heels of massive declines last week. On the other hand, natural gas was down, losing about 4% today alone. And of course, the US dollar was slightly down for the day, and therefore we have a mixed picture here in metals. The drop in the dollar was good for copper, which was up by about 1.5% for the day, although precious metals, gold and silver, were down, even though they should have benefited from the dollar moving down. But remember, they're up big since last week, so we have some de-risking here. A lot of folks are booking profits from gold and silver ahead of the FOMC. Now, I want to concentrate in wheat futures because, yeah, they were down today by about 1% or so, but we have news from the Ukrainian front. You got President Putin saying that he will drop the grain deal after 60 days. So what does that mean? It means the prices of wheat will move higher again. We're going to have shortages if the deal is off the table between Russia and Ukraine. And of course, the Chinese and the Russians are taking over Africa, while we continue to be asleep, of course. And they're doing so by food diplomacy. While Russia says, yeah, maybe the grain deal is off the table, they're also saying, hey, Africa, don't be concerned here because we're going to give you free grain. And you wonder why Africans are choosing the side of Russia and China over the US? Russia and China are exporting grain free of charge to African countries. What are we exporting? Drag? Anyways, when it comes to grain, Ukraine farmers are now saying that the harvest will be 15% less from last year. So this is adding more pain to the misery, which could reduce the wheat output by a lot, which means wheat prices might move higher again. So yes, the Fed might pause raising rates, but make no mistake, the fight against inflation is far from over. And lastly, we all heard the story of what happened in the London exchange. Somebody bought a massive amount of nickel and they paid an arm and a leg for this nickel, but they received a bunch of bags full of stones instead. In other words, they got scammed. And now we know who that party is. It's actually JP Morgan. They got duped. What's going on with JP Morgan as of late? They're supposed to be scamming other people, not the other way around. But I guess karma is playing out right now. I mean, who can forget the girl who scammed JP Morgan Chase out of $175 million? I say this girl is my hero. She managed to scam the kings of scams. Moving on to the options market, the big casino, what do we see here? The volume all in all is down because we have some de-risking ahead of the FOMC. That's natural. Beat at that, the hottest table by far is Tesla, the souffle, with around 1.3 million contracts traded today. About 54% of the volume was calls. And at number 2, Apple, with around 850,000 contracts traded today. About 56% of those were calls. And at number 3, NVIDIA, with around 650,000 contracts traded today. About 51% of those were puts, not calls. When it comes to the unusual activities that took place in the options market today, we don't have a lot because, again, we have de-risking. Nobody wants to make major bets ahead of the FOMC. But we do have one here for illustrations, of course, because the spread is really wide. You don't want to follow it, but the Fed will make a major decision. And this decision will push major asset prices either up or down. We have no idea at all. And therefore, when I look at this trade for the XHB, this is the Home Builders Index, which is really sensitive to rates, meaning whatever the Fed is going to do will impact the XHB dramatically. It's going to be a massive move up or down. And here the trader doesn't know what's going to happen. Is it going to move up or down? But they know there is a massive move coming. But they're expecting a 10% worth of move in either direction, up or down. And therefore, they're buying puts and calls with the same expiration date of June 16th. And they bought the 72 calls, which cost them about $2.40 a piece. And then they bought the 59 puts, which cost them about $3.30 a piece. All in all, they paid about $5.75 a piece to enter this trade. They spent about $8.6 million. Now, I talked about my straddle strategy for ExxonMobil, for example, because whatever the Fed is going to do, it will move oil prices massively up or down. And therefore, I have a straddle on ExxonMobil with a strike price of 100, meaning I bought calls and puts for the strike price of 100. I have no idea what's going to happen, but it's going to be a major move up or down. So we have a lot of traders, for example, making bold bets that the Fed will do one thing or the other as if they know for sure what the market reaction will be. And if their bets hit, they will hit big. If they miss, they will miss big. But we have a lot of professional traders who use these kind of strategies of buying straddles, strangles, buying puts and calls when there is uncertainty of a certain decision coming. But we know that this decision will induce a lot of volatility. Moving on to the heat map, this is what it looks like for the day. We talked about the theme today, de-risking, winners from last week, losers today, losers from last week winning today. And therefore, we see names that won last week, such as Microsoft, Intel, some of these software names, Google, Amazon, UPS, Blackstone, and financials, all down today. And names that took a hit last week, bouncing today. Some of these names are in banks and financials. Some of these names are in energy. Some of these names are in metals. A lot of these names happen to be in industrials, for example, massive rebound here. But that's about it. We're just de-risking, rebalancing ahead of the FOMC. There's nothing to see here. But there are consistent themes. If we are heading into a recession, healthcare, big pharma will do pretty good, and you see big pharma outperforming today. Likewise, the consumer staples will do pretty good. At least they will hold pretty good, and therefore we see them leading the way today. And of course, among the names that will hold pretty good are defense contractors. Defense spending is not going to dry up, recession or no recession. Just look at the headline we got today for Northrop, for example. The U.S. Air Force new 5-year spending plan envisions requesting more than $73 billion to develop and produce its B-21 bombers and Centennial intercontinental ballistic missile. Meanwhile, we have homeless folks all over the place, but it doesn't matter. They're going to spend insane amounts in so-called defense spending out of fears from Russia and China. So these stocks are not going to have a recession at all. Matter of fact, stocks like Northrop and Lockheed are experiencing boom time. And this is why I continue to be long defense contractors. On the other hand, we don't have boom times in Amazon. We have kaboom times. That tsunami of layoffs continues, and now we have Amazon laying off 9,000 employees. And no, these are not the delivery contractors. They're now actually laying off folks from Twitch and AWS. So we have major problems going on here in Amazon. You can say, okay, layoff optimism. Every time a company lay off employees, employees. That means expenses will go down and we have to stampede and buy the stock. But why are they cutting these jobs? Why are they cutting expenses? The answer is because their revenues are going down big time. Is this the reason to buy these stocks? Of course not. Moving on to the heat map for the ETFs, what do we see here? Mixed picture across the board. The winners from last week, a little bit soft today. Look at the XLK, for example. That's down by a little bit. The XLU utilities, the winner from last week, up today, beat flattish. Likewise, large caps were the winner of last week. Now today, large caps positive, yet underperforming mid and small caps. Both of them were laggards last week. Likewise, among the laggards, oil, XLE, XOP, OIH, all bouncing higher today. But all in all, there is nothing to follow here. There is no consistent theme because all what we're seeing is just rebalancing ahead of the Fed meeting. So we're going to move on and cover some charts here and then wrap it up. We begin with SPY. The S&P 500 30 minutes chart, what do we see here? Unchanged, the chart remains within range. The resistance at 393.58, the support at 390. Yes, we got a closing slightly above the resistance, but we're not out of the range by a lot. We did not close the gap above, not even close. And of course, we're watching the trend line, which now coincides at around 390. If that's broken, then we're going to have a sell-off all the way to 385. And if we lose 385 once again, we're going to go down all the way in a retest of the October lows. Now, the bears would argue that this is a bearish, flaggish kind of formation, although it kind of faded away in today's activities. The bulls will counter and say, not so fast, what if this is a cup and handle formation instead? And higher we go. The bears will counter again and say, wait a minute here, let's clean up the chart. What do we see here? Isn't this a giant bear flag pattern? And down we go. Both teams have their arguments right now. It's going to come down to the Fed. When we look at the daily chart for the continuous contract for the S&P, what do we see? Closing above 3,960. This is a good point for the bulls, especially when you look at it from the continuous contract perspective, because we were down big. When we got the scare from Europe and UBS was down by over 8%, S&P futures were down big. And then they made a rebound, a comeback, and they closed above the important line. This is bullish, not bearish. On top of that, we see that the momentum indicators are now reversing negative divergences, be it in the RSI or the MACD indicator. The RSI is now out of negative divergence, and it is a leading indicator. The MACD indicator is about to cross, about to produce positive impressions on Instagram and give us a confirmation that the SPY is now in bullish momentum. But folks, again, it all depends on the Fed. The Fed will produce a massive move one way or the other. And there is no point at all in making massive moves and massive bets ahead of the Fed. But folks, this is really important. Today, I tweeted this. From a technical perspective, the bear market hasn't even started. All what we saw so far is just a correction. I know it sounds crazy, but I'll show you the evidence tonight. It does sound crazy, but is it really? Because we have folks like Morgan Stanley, Mike Wilson, who said 2 weeks ago the market will go down 20%. Now he says we see the end of the bear market coming. Now, here are the facts. When we look at the SPX, the S&P 500 cash index, a weekly chart, we apply the 200 weeks moving average. We only have bear markets when we trade below the 200 weeks moving average. We saw this happening back in the implosion of the dot-com bubble and in the great financial crisis back in 08-09. Right now, as we stand, we haven't broken the 200 weeks moving average. So all what we have is just a mere correction, a pullback. We got a retest of the 200 weeks. We got a bounce from it. But now we have consolidation in a bear flag pattern. Now, if we go down in a retest of the 200 weeks moving average and we fail, we close weekly below the line. This will mark the beginning of the crash and the beginning of the true bear market. You haven't seen anything yet. This is not a bear market, folks. All what we've done so far is fix an insane over divergence from the mean, which in this case happens to be the 200 weeks moving average. Now, usually when we have an insane over divergence one way or the other, the correction is overdone, meaning in the mania bubble of 2020 and 2021, we got an over divergence to the upside from the 200 weeks moving average. And typically, the correction of such extreme divergence doesn't stop at the mean exactly. We see an overcorrection. We see an extreme reaction in the other direction this time around. In other words, we're going to fail the retest of the 200 weeks moving average, and down we go. But we'll take it one step at a time. What about the Qs? 30 minutes chart, what do we see here? Consolidating within range. It is a semi-bearish formation. We had a bear flag formation last week. We got a gap down today, and the chart lost the support of 360. 303.30 for a little bit before we saw the dip buyers showing up, and they got the chart closing within range, support 303.30, resistance at 309. Nothing to see here. When we look at the daily chart for the continuous contract, we have a pullback. We know we have resistance at around 12,766, and the chart right now is gathering some energy to crack above it. We see the momentum indicators improving, be it the RSI or the MACD, but at the end of the day, it depends on the Fed. If the Fed says, hey, risk on no longer because they raise rates or they pause or they do whatever, it doesn't matter. It depends on what Powell is going to say. If he sounds scared about the economy, that we have systemic risk, if he says that the recession odds improved dramatically, then maybe despite the technical formation, which is positive right now in the Qs, we see a pullback, we see a loss of support and a reversal. And maybe this becomes a double top formation at around the resistance of 12,766. What about the IWM, the Russell 2000, 30 minutes chart? What do we see here? The chart is showing a bottoming formation from a 30 minutes perspective. It gave it a shot to crack above 174.22, didn't make it today, but it is now waiting on the green light by the Fed to say, okay, go ahead and rally. Risk on, IWM, go ahead and pop higher. On the other hand, whatever rally we get in the IWM will be short-lived. And the reason is, when we look at the weekly chart, what do we see here? We have a bear flag consolidation pattern. We have a gap fill at 163.62. We filled the gap before, and the chart did retest this level twice. Another retest means it's not going to hold, and down we go. When we look at the MACD indicator, it is curling down, producing red impressions in histogram, indicating that on the weekly perspective, we have bearish momentum. When we look at the dollar, perhaps the most important chart, the weekly chart here, you can't make sizable bets one way or the other ahead of the FOMC unless you know for sure how this chart will react in the aftermath of Jerome Powell. Right now, it could go either way. Dollar bears will look at this as, hey, look, we have a head and shoulder formation. The MACD indicator is showing loss of momentum, and down we go. Dollar bulls, market bears would argue, no, it's not. We could see a revival of the bullish momentum in the MACD indicator and the RSI, and what we're seeing right now is an ABC pattern. We have a pullback for now, and then we're going to see the C leg forming after Jerome Powell speaks. The daily chart is losing momentum. It is about to retest 103 as support, but it's all about the weekly, folks. Once we get a confirmation, then we're going to have clarity on which direction the market will go. Why FOMO? Why get ahead of the action? I don't understand it, folks. But anyways, here's gold, the old man. What do we see here? On the daily chart, the move got out of hand. It is way overstretched. You can say we're heading into a recession and you got to buy gold, but this is FOMO. This is fear. Let's stampede on buying gold. We got it way overbought right now. The risk versus reward says that we're going to see a pullback in gold. The pullback will be an opportunity to buy in the long run because we know that the inevitable destination for the economy is a recession. And if that is the case, and we see the Fed perhaps easing the monetary policy, whether because they see a lot of systemic risk, whether because they see recession creeping in, more job losses, for example, then we're going to see the dollar moving down. And this is going to be good for gold in the long run. Now, will it be good for oil? If the dollar goes down in a recession, which we haven't seen before, usually when we have recessions, the dollar goes higher because we have the rush to safety. But QE distorted everything, and now we have QT. If the Fed continues to tighten to take down inflation, the dollar goes higher. But under a recession this time around, the dollar is going to go down. So will this be good for energy? In other words, will we see stagflation in the economy, where the recession force takes over, yet energy prices linger on at a higher price? For now, the technicals are saying that traders and market participants are using the old playbook, that if we're going to head into a recession, you dump energy. And indeed, they dumped. And now we're below 77. Yes, the chart is oversold on Brent here, a daily chart, so we could see a rebound. Yet the damage is already done, technically speaking. If you follow the charts, the weekly chart says oil is done. It's going to go down. Maybe it sticks at a higher price at the 60s or the 70s because the dollar is going down in the long run. But is that going to be good enough for energy stocks? I don't know. I don't think so. I don't think in a recession, energy stocks will do pretty good. So this is a time of massive confusion among energy investors. We know the technicals say it's over. We know the price action in the majority of stocks say it's over. Then you look at the fundamentals, be it OPEC Plus, be it the shortages that we still have, be it the war in Ukraine, be it the refilling of the SPR, be it the geopolitical situation, be it the weakness of the dollar, and you say maybe in this recession, oil is not going to go down big. For now, we don't know that yet. Keyword yet. What is the harm in de-risking and listening to what the charts are saying right now, which is oil is going down? Why not hedge by buying put options? Why not hedge by consolidating your energy positions? I used to have 10 stocks, for example. I got them down to 5. Now I want to get them down to 2 max, maybe Chevron and Valero, but that's about it. When we look at the 10-year yield, what's happening here? The daily chart, massive crash. This is historic. We've never seen anything like this before. We've seen something close back in 08, but not to the same magnitude. What we know for sure right now is we have a gap open on the daily chart at around 4.59. What if the Fed, as they expect of course, announces 25 basis points hike and then a pause? Could the initial reaction be filling the gap above, a rally in the 2-year, and then it moves down again and consolidates? Because right now the price action is pricing in a cut. What if we don't get a cut? We get a raise and pause instead. And the 2-year moves higher, and with that comes a pullback in risk on assets. But then comes the pause part. We see the 2-year consolidating within a range until of course something else blows up, and then we get expectations of rate cuts and the 2-year moves down. But we'll take it one step at a time. When it comes to the 10-year, what do we see here? Massive pullback. Below 3.5 for now, but the price action today made a retest to the lows, which is a previous support. As you can see, it held on twice. This is the 3rd time we get a rebound from this point. My expectations are the initial reaction would be a pop higher, maybe a retest at 3.8, and then the 10-year goes down again. What does that mean for the TLT, a daily chart? What do we see here? We have a bear flag consolidation pattern. The assumption for now is the Fed raises and pause, and in reaction, the TLT goes down, maybe all the way in a retest to 103.5, maybe all the way to closing the gap below, maybe all the way down to 100. We have no idea which support will hold because we have no idea which resistance will stop the pop in the 10-year. Is it going to be 3.5, 3.8, 4, 4.5? Who knows? But we know in the long run, if we have a recession, the 10-year will go down, the TLT will move higher again. The VIX 4 hours chart, what do we see here? The momentum is negative, be it in the RSI or the MACD indicator, but it is hugging and holding on 24.29 as support. In other words, the VIX right now is gathering energy for what? For the next pop higher. The next pop higher is not going to happen without a flush down in the SPY. Yet we looked at the daily chart for the futures for the SPY, and the chart looks as if it's turning its way to the positive direction. So we have a conflict here, and the conflict will be resolved by the Fed, and therefore getting ahead of the Fed by making major moves and major bets is extremely dangerous. Apple 30 minutes chart, what do we see here? Above the double top line, which was 156.24, but on weaker momentum. What does that mean? The volume was weak, and therefore we see the RSI pretty much flattish, didn't pop higher at all. We have a rising wedge right now, indicating that we could see, despite the positive move today, a pullback in Apple. But we're not going to know until we lose some support lines. We have to lose 156.24, then we have to lose 154.60, and that will take us all the way down to 152.03. You can round that down all the way to 152. If 152 is broken, then the momentum change from bullish to bearish, and comes the ultimate test, 150. If it is broken, we have a closing below 150 for the day. The bears win, and they will take it down to 145, if not below. Tesla 30 minutes chart, what do we see here? So long as the chart is trading above 180 as support, the bulls are still alive. And they got the fill the gap resistance at around 187.68. That will be target number 1. If they pass that test, then we go back to 194.55. But we'll take it one step at a time because the bulls are not out of the woods yet. If the bears continue to crack the whip and the chart loses 180 once again as support, then we're going to go down to 172.5. And after that, we're going to see more capitulation by the bulls, which will take us all the way down to 164.5. It's a battlefield for now. The bulls made their move, the bears countered, and now we have the battle of which side will win the battle once and for all. Is it going to be the bulls who won year to date, or is it going to be the bears side who won the recent ambush? Last but not least, what about Bitcoin? Tulips, what's going on here? A daily chart. We have an explosive move here, no surprise, and we're now trading above 26,555. But the move has also got way overextended. You look at the RSI, you look at the MACD indicators. The chart is now at the risk of pulling back dramatically, but it all depends on the Fed. We know that we have a correlation between the dollar dollar and Bitcoin. And Bitcoin moved ahead of the dollar, expecting the dollar to move down. In other words, Bitcoin is saying whatever the Fed is going to do, the reaction would be the dollar moving down. And I'd rather FOMO and buy Bitcoin right now ahead of the move. What if that doesn't happen though? What if the dollar catch a relief rally because of the commentary of Jerome Powell? Then we're going to see a big pullback in Bitcoin, a loss of 26,555 as support. Yet the good news for Bitcoin bulls is they built up a lot of cushion here. Even if 26,555 has lost its support, you got 23,189 as support, and then we'll take it from there. Now the question becomes, what if the Fed pushes the dollar down? Whatever Powell says, the dollar goes down in the aftermath of the FOMC. What is the upside target for Bitcoin? I see around 31,000. We'll talk about this target if we get there to begin with, but keep 31,000 as the reference for now. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We don't have a lot. We have existing home sales, but the majority of the action will be in preparation of the big event Wednesday, which is the Fed interest rate decision and the conference by Chairman Powell. With that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching, and I will talk to you again tomorrow. Take care.
I like these calm little moments before the storm.